Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thank you so much for tuning in today to our Real Estate Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from the #1 business radio station in the San Francisco Bay Area, KDOW 1220 AM, the Wall Street Business Network. I'm Tom K. Wilson, your host for the weekly program on real estate investing. If you can't make our live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. Our program today is on commercial and multifam investing, and with our special guest Michael Becker, whom I'll introduce in a moment. If you go to TomWilsonProperties.com, you can sign up for our weekly newsletter that also gives you access to special deals. Most of our products are only available to our own client base, and if you sign up, you can get access to these deals that come out. Also, there's a lot of education information on the website about real estate investing. Welcome you to explore that. We have a new website out now that's been upgraded with some more information. Also, all of our past podcasts are available on there. Folks like Tom Hopkins, the nation's leading sales trainer, and one who we just talked with about negotiating. Robert Kiyosaki, Bruce Norris, Dr. Doug Duncan, Chief Economist Fannie Mae, and so forth. We have some wonderful guests and wonderful topics, and you can look up and go see those podcasts. And we always welcome your questions, suggestions for guests and topics, and we certainly offer consultation as well on the different options that you might have to go with real estate investing future. So it is a great pleasure that we have someone we've known for a number of years, as a good friend and a very successful investor, Michael Becker, with us today, who's a senior director for Old Capital. That is a commercial multifam brokerage firm out of Dallas. Prior to that, it was with Wells Fargo. It's been in the lending business for commercial product for about 15 years. Done a lot of underwriting, has closed multifamily, office, industrial, medical, hospitality, shopping centers, and others throughout the Southwest primarily. He's an investor himself, had many years investing in both houses and commercial and multifam products. He's done over $400 million worth of business, raised $75 million in equity, and has closed on 4,200 multifam products. So he's both experienced in investing himself, in underwriting for others, and putting together large deals. So very knowledgeable guy, and wonderful guy that I'm glad to know. And Michael, welcome to the program.
Hey, Tom. Thanks for having me.
It's a pleasure. So, Michael, let's let our listeners hear briefly your story on what took you down the real estate path, and I'm sure this is probably exactly what your formal schooling sent you toward, right?
Exactly right. So, as you mentioned, my background is I'm a banker by profession. And been doing commercial real estate lending for over 15 years. And along the way, I realized that I was on the wrong side of virtually every transaction. It was better to be the borrower than the lender. So unlike most of my counterparts, I went out and did something about it. So I started out in 2010, I believe it was. Started buying some single-family homes during the Great Recession, and I realized that wasn't a very scalable business model in the grand scheme of things, and I wanted to go quicker and faster. And I was a specialist in multifamily apartment loans. And then I decided to make the transition over and kind of jumped in with both feet. Like you mentioned, over the last 4 years or so, we've done about 4,200 units, over 20 properties, over $400 million in transactions, both on the buy side and selling, all located in DFW, Dallas-Fort Worth area in Texas, where I'm based. And then we'll go out, we'll do syndications, much like yourself. We'll go out and kind of pool capital from multiple independent people and do a private placement memorandum and take the properties down.
So when you before you went into the banking, was that your career objective earlier on, or how did you happen across that?
Like I said, I was just went to college for finance, and just one of the first job out of college was being a banker, and just kind of stuck. So I ended up getting in the credit department at a local bank and learning how to underwrite loans, and worked my way up to be a pretty successful loan production officer. And I would just produce commercial real estate loans, like income real estate loans. I did a retail, office, industrial, and multifamily. And kind of towards the end of my banking career, what I focused primarily on was multifamily. And really what I just noticed was I'm making all these loans to a lot of my clients, and I knew as much or more about it than they did, but I was making a nice salary and they were getting wealthy. So that really kind of just motivated me to go out and take some action and start putting deals together myself.
So to our listeners who maybe aren't real sure what the term means, underwriting in the banking business, it means that you have analyzed the deal and are willing to make the loan on the deal, but the more general term, and you can add your flavor to it, Michael, but it means doing the financial analysis to see if a deal makes sense. And having that experience for 15 years in the banking business of learning how to work the numbers and knowing what the typical numbers are and what they should be for a good deal was certainly an invaluable skill set for you in learning how to do your own, right?
That is very true. It's very invaluable because all I did for years and years was just look at other people's potential transactions, underwrote it, both from, I was able to learn quickly how to analyze a deal and understanding are their operating expenses out of whack versus what market expenses are, help do market rental surveys and understand whether rent's too low or they have the ability to go in to raise rents. It just really allowed me a lot of repetition on someone else's nickel. So I got to learn on someone else's nickel for years and years before I went out and did it on my own.
Yeah, that's really wonderful to see what the norms are. Then when you see a new deal, you know if it's out of whack on either the bad side or wow, this is a better deal than average, right?
That's very true. Really helps you identify if it's an opportunity or something you should pass on quickly, and that's really helps me avoid wasting a lot of time on deals that never ever going to make in the first place.
Well, our listeners certainly know that my connection with Texas and Dallas is not from anything personal. Never lived there. Don't have any roots there at all. But as a techie, 18 years ago and 19 years ago, and I started studying for the best place to go, it just came out on top. There's certainly lots of cities, most any place you can make money if you do the right deal, if it relative to whatever your objectives are. But we, as Wilson Investment Properties, will be bringing in opportunities from other areas to give people diversity, and it's very deal flow is pretty tough. Others have discovered places like that. But best I can tell, and we're watching it, of course, daily, like you are, Texas and Dallas-Fort Worth still seem to be economically really on fire. Would you agree?
Yeah, I've been blessed, unlike you, to be born and grow up in a market that is landlord-friendly and has a very positive business culture with lots of growing demographics and population growth. So we really have been fortunate in our market to have a lot of economic activity going on, and the growth of Texas, and specifically the Dallas-Fort Worth area, has just been staggering with all the population immigration from different states across the country, including people from California moving to Texas, as well as a lot of and what they're doing is they're following jobs. We've had over 100,000 jobs in DFW for the last 5 or 6 years in a row. So we've really had quite a bit of influx of jobs in population, which certainly feeds commercial real estate, and more specifically, multifamily housing really is very supportive of keeping our properties full, as well as keeping the rents rising.
I keep rereading the stats in disbelief that maybe I read something wrong, but 1/3 of all the jobs created since the crash have been in Texas, in the country, which is pretty hard to believe. There's a section right now of north side of Dallas, which is referred to as the $5 billion mile, and it's not correct. It's currently a $7 billion mile. It's a stretch there on the tollway that's got 5 major companies like J.P. Morgan Chase and State Farm and Toyota and Liberty Mutual and the Cowboys' new headquarters and 2 huge mixed use, and there's still some space left, and there's a lot of cranes around DFW, aren't there?
I am literally sitting right across the street from the Cowboys' new world headquarters, so that's where my office is located, and the amount of development and cranes is just absolutely staggering. And like you said, it's billions and billions of dollars of development, and I moved up to a city called McKinney, which is just north of DFW, and about 4 years ago, and my commute's been materially worse coming into the office just because we have more and more cars on the road and more employment centers going further north up the North Dallas Tollway, which is in the Platinum Corridor, the $5 billion mile that you just referenced, Tom.
Yeah, and it's of course it's as a good news, bad news thing. One, it's still got high growth, and therefore products are doing very well. I think it was Forbes that just ranked Dallas number 1 in the country for 2017 investing. Did you see that one?
I did.
Yeah, pretty amazing. And of course, the negative is that now continues to be high demand for limited products. So you really need to have someone or someones who have access to a lot of deals to look through to pick out the nuggets, because it's a lot of work and to find those few, but they're there if you do a lot of looking and look through a lot of things, right?
That's right. Yeah, you have to kiss a lot of frogs to find the right one. That's for sure. And that's certainly what we hopefully that's what we've been successful in doing. We've certainly done a lot of deals, and so far the market's been strong, and we've had some pretty good outcomes over the last several years. Yeah,
and if someone is thinking about striking out and trying to do it on their own, they certainly can, but it's pretty tough. I think no matter how you go about doing it, I'd find a syndicator, a partner, or someone that's got huge access to deals and knows how to underwrite the things. We have Michael Becker with us today, who's a very experienced investor and very knowledgeable in the multifam and commercial arena, especially multifam in the Dallas-Fort Worth area. And we'll be back in just a moment.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
And Michael Becker with us, very experienced underwriter and investor and syndicator of Commercial Multifam Products. Now, Michael, you've done commercial, and I know you know that Wilson Investment Properties does both commercial and the of non-multifam products as well as multifam. So we like both. What's your feeling about the pros and cons of one versus the other, multifam versus non-multifam commercial?
I've just taken the approach of focusing strictly on multifamily investments for my personal investments and then what we go syndicate. But I do have some experience in my background, especially as a banker doing loans on retail, office, and industrial buildings. Some of the main differences in my observation and my experience is are that the commercial properties, obviously they're by definition not a residence where someone lives, so you rent to other businesses typically, and these businesses have employees that live there or people that come in and shop. So some of the key differences there is the housing is a universal need, so it's typically a little bit easier to lease out in case of a vacancy, so your vacancies are typically shorter in a multifamily property than they are, or potentially can be in commercial or retail or industrial. That's one thing. Another key difference between them, when you have an apartment complex and you have one of your units go vacant, you just typically come in, clean the carpets, paint it, move someone else in. So you have a few $100s in turnover cost, unless there was some major damage to the unit or you can do some systematic upgrade to the unit. Where in, like an office building, for example, when someone moves out, you have to pay leasing commissions and tenant improvement allowance typically. So you have to pay, upwards of 6% of the total term of the lease payments in a commission, as well as give, multiple dollars a square foot in a tenant improvement allowance so the new tenant can come and reconfigure the space. So the commercial buildings are a little bit more capital intensive every time you have to turn it over. Kind of on the flip side, though, if you have a good commercial building, you have, instead of having a 12-month lease like you do on apartment complexes, you have, typically 3, 5, or maybe even longer term leases in place. And also you can a lot of times put some of the operating expenses back onto the tenant on an office building or retail center, where on the apartment complexes you typically, as an apartment owner, bear most of the operating expenses of the buildings. So those are some of the main key differences that I've observed between the two. Okay,
and they so like anything, they both can be good, but got to get the right product, and it's got to be, in both cases, it's really critical to be managed correctly to execute the project to reach the goal.
Very true.
It's make some comments about property management, how important that is, and some of the key things you look for to do when you're selecting a property manager and for multifam?
Yeah, that's certainly one of the most critical decisions you're going to make if you own an apartment complex is how you're going to manage it. Some people think they can come in and self-manage, and it's very possible to do, but you get these larger apartment complexes, it's not just buying like a piece of real estate. You're buying an operating business, so you have staff that is on site that you have to manage, as well as having hundreds and hundreds of people typically that live that are unrelated, that live on your property in close proximity. So there's a lot of kind of like adult daycare and a lot of cases that you have to deal with.
I haven't heard that one. That's good.
Yeah, it is like adult daycare in a lot of cases, and you got to deal with that. So you have to, when you manage an apartment complex, the management company typically has 3 main functions in my observation. You have the HR part, so you have to deal with staffing. You have construction, which means you got to make ready the units when they turn over, plus deal with any sort of maintenance issues along the way. And then you have accounting, which they do your books for you, collect all the revenue and pay all your expenses and do your monthly financial statements. So those are 3 key things that you need to make sure that you have an experienced management company that has experience in the area that you're looking to buy, and then the asset class that you're trying to buy as well. So I wouldn't hire, say, like the largest multifamily property management company in the country is Greystar, and they manage hundreds of thousands of units, and they focus on Class A products all across the country. I wouldn't hire them to run a C-class property in a workforce housing neighborhood in DFW. That's just not what they do, and their expenses would be out of whack, and they just wouldn't be as efficient as I would find a local firm that specializes in that, and that's who I would hire for that particular type of asset.
Okay, matching it up is critical. We have Michael Becker with us, experienced investor, lender in the multifam commercial business, especially multifam, and we're going to ask Michael some more questions about how he picks a product, how he picks a market, so forth when he gets back. So stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Michael Becker with us today, and before the break we were talking about the importance of property management, and not just because they're good at one thing doesn't mean they're good at all products. Depends on the type of product and the need, whether or not it needs construction and upgrading, or whether it just needs to be stabilized, matching the class that they're experts in. So Michael, talk briefly about the different classes of product and what you think is the pros and cons.
So the apartment complex, you have your different product types, like we talked about. You have retail, office, industrial, and multifamily, kind of 4 major food groups in the commercial real estate world. And then within those, you have Class A, B, and C products. So kind of Class A, think of like brand new, for apartments specifically, it would be like brand new construction, last several years, top flight amenities that have, upgraded units like with granite and stainless appliances. That's kind of like your Class A product. Your B product, in my market, is typically stuff built in the 1980s, maybe into the early 90s now. They might have, instead of having 9-foot ceilings, you have 8-foot ceilings with popcorn on them, have like laminate countertops and any black appliances. So just stuff that's, 20 to 30 years old. That's kind of the B product, and the C stuff in my market is kind of pretty much the 70s and older. And that would have, limited amenities. They may or may not have a pool in it. And doesn't have all the same stuff that the newer stuff has. So, kind of the lower end of the scale, you have a little bit more of the workforce type housing, people that kind of have blue collar jobs or maybe a call center type job would live in a Class C or Class B apartment, where the Class A are kind of more the white collar or a little bit higher paid professions would live in a nice Tony or Class A apartment complex.
Which ones have you had the best returns on?
When we started out, we focused really on Class C multifamily products. Typically a little bit less expensive per unit, and some of them are a little bit smaller. And then now we pretty much exclusively have done kind of Class B product, and we've dabbled in a little bit of A- product, some early 90s into the early 2000s, but still have a kind of what we focus on are like light value add properties where we can come in, spend $3,000 to $5,000 a unit, upgrade like the flooring, appliances, light fixtures, etc., and then try to come in and raise rents $100 a month, something along those lines. And that's really more common and prevalent in the Class B product, as well as the price point is a lot more affordable. There's a lot more people that can afford the Class B products than the brand new Class A units that are coming out of the ground.
So why are you focusing more now on B instead of C and A? You touched on it a little bit. Can you expand on that a bit? We've got about a minute left in this segment.
One of the things in my experience with the Class C product, the Class A product just doesn't return as much. You pay a lower capitalization rate or cap rate, so the amount of return that you get is just not as high from a cash flow perspective on the Class A. So going down to the B product, when I started out doing the C's, there's all these buildings are typically a little bit older, so you have things like cast iron sewer or aluminum wiring in these properties that are built, before the 80s. In the 80s products, you typically have PVC sewers and copper wiring plus some nicer construction components. So what I found, these older properties have all these non-recurring expenses that keep recurring, like your sewer system is eroding, or the foundation issue, or whatever. All these non-schedule items that keep popping up that take your cash away along the way that the B products just don't have quite as much, as well as you get a little bit nicer clientele in the Class B product, and you're kind of in the middle where you catch, in a good times, you catch the people that are trying to move up out of the C products will kind of go into the B, and then bad times, people that can't afford the Class A product will move down into the B products. So you're kind of insulated a little bit better from the economic cycles along the way.
Good, yeah. So B is kind of in between the two, and get a better quality tenant than the C, but you've got more affordable than the A. I like B's myself, especially I've had A, B, C, and they've done the best for me. So we'll be back in just a moment with Michael Becker here talking more about multifam products.
Welcome Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
I have Michael Becker with us today, experienced investor and lender, underwriter, whom is talking to about the commercial and multifam products. And that's an area that confuses people a bit, Michael. From an underwriter perspective, do you generally include multifam within the general umbrella of commercial?
Yeah, the apartment complexes are considered part of commercial real estate, but they certainly have much more favorable financing that's available for apartment complexes than typical for the other the other food groups of the commercial real estate world.
Yeah, I find often in conversations when people say commercial, often they are excluding multifam, but technically it's included. But indeed, the underwriting and so forth is quite different between the two, and you find some banks only do multifam and not do commercial, right, and vice versa?
That's right.
Okay. Let's just continue just a little bit more, because I think this class thing is pretty important. So certainly you can have success in all three of the primary classes. Class A tends to be restricted to REITs and large institutional investors. I think in part because they tend to be larger. They can deploy more money there. But I think their client base or investment money base considers them to be safer, and therefore they're accepting a smaller return. Would you agree with that?
Yeah, the durability of the income is perceived to be stronger in kind of the core markets, kind of the best locations on the newest products. So people are willing to accept a little lower rate of return for the Class A's than they would kind of going down the class rankings.
I didn't miss that you said perceived.
Perceived, right? Yeah, it is. And everyone's got their opinion on that, but I think it's a little risky going in. Some of these core markets, like your backyard in San Francisco, I believe the last several months you guys have had the Class A rent soften and decline over the last several months because you guys put up a ton of brand new units in a highly concentrated area, all trying to get top of the market rents with the highest amenity set. So there's only so many people that can afford that type of rental rate, and there's only a limited amount of demand. So I just don't think that it's that deep of a market at the top end of it. So in my opinion, I think it's a little bit more risky at the very top of the market than it is kind of in the middle in the B class.
I kind of think so too, and I think it's less. It's more risk when you have a recession, because I think a lot of the A's then can move down to B's, and the vacancies historically, from what I've seen, are a little bit higher in Class A than they are in Class B when you go through a down cycle.
Yeah, I think there's definitely more risk at the top because when people are in a recession or they feel uncertain about their income streams, is certainly one of the things they'll do is they'll look to try to save a few $100 a month by moving to a little bit older apartment complex.
When I was talking to Doug Duncan, Chief Economist Fannie Mae, not long ago, asking him about absorption and saturation, he said he felt that in some cities, the almost all new product that's built is Class A, and so therefore it was starting to reach some saturation and having some absorption problems. But in B and C, they don't build any of that stuff anymore. So if you can find one of those, that's a good deal, and maybe do a little bit of a upgrade value add, that can work out still fine even in hot cities. Would you agree?
Yeah, that's exactly what we focus on, kind of the light value add and the B class apartment complexes. And so what we do is we'll come in, like I mentioned in one of the previous segments, we'll come in and do new flooring, appliances, light fixtures. So we're not going to be as nice as the brand new product, but we're comparable from those aspects, and we're 20-30% cheaper on a monthly basis than what it would take to be in a brand new Class A, and that's a renter having $200, $300, $400 a month and rent difference is a material amount of money to their daily lives and allows them to go out to eat or pay for groceries where they otherwise couldn't. So having a little bit more affordable units is definitely, I think, a little bit safer in my estimation, as well as what you mentioned. Not only do they not typically building Class B or Class A or Class C apartments, only in kind of the brand new Class A. And that's a function of having, rising land costs, rising city impact fees to even just get a permit to build, plus on top of all the construction materials going up. You have to pencil out these really high rents to make these deals make sense, to get them financed and then come out of the ground. And if anything, what they do is when they build these brand new Class A's, they're taking supply out of the Class C and Class B market when they buy existing deals, tear them down, and then replace them with brand new Class A. So not only population getting bigger and bigger, the supply is actually getting smaller and smaller, these older deals. Mm-hmm. So I think it's really, we've been fortunate in the last several years, have had some pretty decent projects, and I think it's a pretty safe place to be, as well as has, the ability to get some outsized returns in this space.
Got about a minute left in this segment. What's your thoughts about buying a value add versus stabilized product?
So the stabilized, there's nothing wrong with buying a stabilized property. What we always have tried to do is we won't buy a property unless it has some level of value add to it. And that's not only because we want to come in and have, better returns, but it's also a way to kind of mitigate your downside. If you buy something that is performing perfectly, there's only one way to go, which is down. If you have something that you can come in and improve operations, it also, maximizes the upside a little bit, but it also kind of hedges your downside if rents soften. You still had some ability to raise rents along the way, so it doesn't hit you quite as bad.
Mm-hmm. Okay. And what are some typical value add things that you do?
Like I mentioned, some of the interior stuff that we've done already, but on the outside, we add dog parks, we add playgrounds, outdoor kitchens with pergolas, new signage package, update the office, fitness centers. Those are some of the things that the 70s and 80s vintage product did not have when they got built, and that the new Class A does. So you do some of those, and it's a relative value on your property compared to some of the newer assets that they're building right now.
Mm-hmm. And for whatever class product you have in a whatever class neighborhood, it's always good to figure out how you can get some product differentiation by having some things that don't take a huge amount of capitalization but differentiate you from somebody else. We got Michael Becker with us today, very experienced investor and syndicator in the multifam arena and underwriter, sharing with us his thoughts. Will you stay with us? We'll be back in a moment.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
It's been a pleasure having Michael Becker with us. He hasn't been in the business for decades, but in a short period of time, by golly, he's covered a lot of ground and learned a lot. And I always find I learn the most from talking to folks that have a lot of experience, and we appreciate you sharing your thoughts, Michael. One thing we haven't touched on, which is spent 15 years in the underwriting business, just which way is money going to? What's the availability of money for multifam and commercial today compared to a year ago?
With the exception of ground-up construction loans, which are very difficult to do, there's abundant money from banks and other lenders out there like Fannie Mae and Freddie Mac to loan on existing stabilized apartment complexes and commercial buildings, as well as value-add apartment complexes and commercial buildings. There's certainly no shortage of debt available for that type of product.
However, if someone, we've run across folks that have bought houses from us in the past, and that's how you and I connected years ago, was kind of in the house investment business. And before we, expanded into some bigger stuff, a lot of folks think, well, I've got a good credit score and I got some good money stashed away from my stock options here in high tech or whatever. And I think I'll go out and buy a multifamily or commercial property on my own. Now, what a lot of them wind up doing is going into syndications instead because they can spread their risk and less liability and headaches. But it's still fairly tough for someone to get a loan if they've never been in that business before in the multifamily commercial, correct?
Yeah, the banks and Fannie Mae and Freddie Mac want to have experienced borrowers, so you need to have someone with some level of experience on your team to kind of do your first deal, and then it becomes easier afterwards. But to get your first deal done, you definitely need someone on your team with some experience.
And they used to be, it was before the crash, as long as you could smoke a mirror and the product was good, you could kind of get a loan, but that's tightened up in this world as well.
Long gone to those days.
Yeah, that's the bottom line. But if you have someone that's on your team that you're working with that can qualify for loans, there's money available, and it's still awfully cheap stuff, isn't it?
That's right.
Yeah. Michael, if folks want some more information that you provide, you've got a website. What is that?
Yeah, there's two ways you can find out more about us. My business where we go out and do multifamily syndications is SPI Advisory, like spy, spiadvisory.com. You can find out all contact information there, as well as my lending partner, Paul Peoples. We have a podcast that's on iTunes and Stitcher and a bunch of other places. You can search Old Capital Real Estate Investing Podcast. It's Old Capital Real Estate Investing Podcast. Or go to oldcapitalpodcast.com and you can find it. We talk to other apartment owners and people in the business, in the multifamily business, and kind of interview them and talk various subjects about financing and operating multifamily properties.
Wonderful. And I will see you at syndication seminar coming up here in a few weeks. And you going on Summit at Sea this year with the real estate guys?
We'll have a drink in the middle of the ocean as well.
All right. Look forward to doing that again with you. Thanks so much, Michael, for being on the program. And go to TomWilsonProperties.com so that you can sign up for our newsletter, get access to deals, and also get more education information. And let us know your questions. And also look at podcasts where if you don't catch it live, you can go on and look at podcasts from folks like Michael Becker. So nice to have you with us. And remember, the only thing that matters is what you do next.